Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Friday, June 5th, 2020. What we're going to do is somewhat of a follow-up to the earlier video, but I'll condense it. I'm not going to cover as many different asset classes. We won't look at the commodities. We'll focus on the stock market, treasuries, and gold, because they're interrelated or related somewhat. And I'd like to just take a quick look at the FAANG stocks on a longer term chart. I've been highlighting those recently on the 60-minute time frames, looking at some levels, some trend lines that we've been walking up. Majority of those FAANGs are still above those trend lines, so we didn't get those sell signals yet. But I want to look at the weekly chart because there's some developments worth noting, and that also might give us some kind of projection on, if there's going to be more upside from here, how much more upside and for how much longer. All right, so we're starting out on a monthly chart. We're going to start out in long-term charts. This is the picture going back for decades here. You can see the previous bull markets and the previous bear markets. We had a bear market there, 51% drop, bear market 2, 57% drop. This one's not measured out. I think it was about 36% or something like that. And then some big corrections along the way. What they have in common is they all came with these divergent highs. You can see negative divergence down on the indicators down below, and divergent highs and drops anywhere from, again, 15 up to almost 60% on the indexes. So what's going on recently? Well, as I said, a few weeks back, the technicals, what would start to change the near-term outlook? Well, when certain levels get taken out. One of those is the 20-month EMA. As I mentioned last month, we closed above it, and by a relatively small amount, but so far we're comfortably above it right now, so that I only can increase the odds that the market might make a run at the new highs, previous or all-time highs, I should say. Previous highs are about 6% or so above, as I covered today. Now, remember, this is a monthly chart. These are monthly candles, and I've gone over this many times. That 20-month EMA, it is not unusual. In fact, it's more than common to see either an intra-month break above or a temporary one-monthly close above or below. You get a whipsaw like back here. We'll see. But again, the farther you get away from it, the less the odds are that it's a bear market rally, because that's done a great job, as I showed you in the past, of defining bull and bear trends. That's this blue dashed line. There's a great bull market there, one of the strongest and longest up to that point in time, followed by a big old bear market, and you can see it there. So we broke that candle and closed, broke the candle. The candle there for the month of March closed solidly below that level. The following month we back tested it from below, but then we regained it in the month of May, and we're above it now. Still a lot of days left in the month here. Today is, again, only June 5th, so we have pretty much a whole month to go. And the one thing I can tell you is a lot can and often does happen in 1 month. Not always, but again, so let's just talk on that when the end of the month comes. We did take out also, we took back, I should say, this trend line. This was the lowermost uptrend line for the bull market, the white trend line, the one right here. And again, there's no way for me to spin that as anything but bullish right now, as long as that holds. We had another trend line here, the yellow trend line, that was broken before in back test. So, the big picture is we had the divergence. Divergences did play out. That first small divergent high played out for a 20% drop in the fourth quarter of 2018. This one played out for a much larger drop. And the million-dollar question, is that it? We'll see. Now, depending on the rate, if we continue higher, number one, if we continue higher and take out the previous highs, how we do it. In other words, does it take a while? Does it take months or so? Or does it happen relatively quick? If it happens anytime soon, it will simply be an extension of these divergences, and just like I show on daily charts and even 60-minute charts, sometimes you have these series of divergent highs, and then finally they play out for the big move there. So but as of now, today's price action and this week's price action, since this weekly candle is closed, well, we're on a monthly chart, let's go down to weekly. Again, that won't matter until the end of the month, but here's today's weekly chart, and we're well above the 40-week exponential moving average, which is the same as a 200-day moving average, and we're also above the 200-day simple moving average. So again, those are things that simply chip away at the bearish case. But unless we make new highs, it's still too early to say, hey, is this just a sharp counter trend rally fueled by a lot of Fed liquidity and market measures, or is it one and done? One of the fastest and shortest bear markets in history. We'll see. Only time will tell. All right, so that's that. Like I said, powerful price action today, especially in the small caps. They were the ones that really stood out. SPY is still coming up to that gap. Again, everything I covered in the video earlier today. Here's a pretty clean trend line to watch right now. We're comfortably above that trend as of now, and so we'll have to see what happens next week. We do have a gap away, a candle right here, breakaway. Could it be an exhaustion gap? An exhaustion gap, if you Google the term, comes after a prolonged run. You have breakaway gaps that occur early on in a uptrend. And then you have continuation of gaps that occur, in the midpoint of the trend, and then you have exhaustion gaps that sometimes that's it. You get that exhaustion gap, and then if they fade it, that's pretty darn bearish. And remember, on the 60-minute chart below, we have Gap City now, where we have 1, 2, 3, 4 unfilled gaps, including today's. So this is all the stuff we'll watch short term. Everything else right here, the 60-minute chart, and what I started on earlier is stuff that we're going to watch longer term. And again, weekly charts, all that matters is how you close the week. Monthly chart, how you close the month, etc. So that's it. Let's look at Treasury bonds. Okay, so as I mentioned the other day, we broke down, and I said this, unless that breakdown reverses, it is indicating that we could have some more upside in the market, because that shows money coming out of treasuries. And again, we fell down. Today, I said at this point in time, it's no longer an objective short. It was early on the breakdown, but I said we're probably due for a bounce, because TLT was coming up on support here about 153. And pretty nice bounce off the lows today. We bounced, which is in treasuries a big move, about 2% off the lows. We still closed down, so that's worth noting. And on treasury bond futures, we hammered right off that trend line that I highlighted in the video. This is a daily chart, long-term chart here. All those reactions, we kissed it. We were trading on it during the video, and that's where I said, at this point it's no longer objective short. Probably get a bounce here in Treasury. So there it was. Now, whether it's fleeting or not. Now, the reason I wanted to bring it up is because we'll have to watch this next week. If Treasuries continue to rally, and I could certainly see that they're deeply oversold. Before I leave this chart, let me just mention that. I think I covered it earlier today. Here's the RSI down here. We're oversold. The last time treasuries were oversold was right there, and the time before that was right there. So you can see in each of those previous incidents, and that goes back for 2 years, till we get down to that level, there wasn't any more downside. Right there, you were oversold, and what happened is you went on. We didn't drop anymore. We made roughly an equal low, but then we put in positive divergence right there, and that led to the big move up in treasuries. Here, we were oversold. We had an initial bounce. We continued to diverge, and then a big rally there. So again, at the very least, the odds favor, I think, some more upside here. And let's go back to that 60-minute chart here. All right, that's what it looks like. There was a breakdown and back test. Again, multi-month trading range right there, and a pretty sharp snapback in treasuries. So what does that mean? Well, if there's more upside next week, let's say, and where would we go if we do bounce next week? I'm standing aside this one for now. I'm watching, but I think a bounce back to test the bottom of that range makes a lot of sense. That's a very obvious level, and if so, treasury bonds are typically a risk-off asset. Not only are they a risk-off asset, in other words, they tend to drop when the stock market's rallying, or often in anticipation of a stock market rally. There's institutions, smart money usually, the big institutions are the ones that tend to buy treasuries. And when they want in the market, they're going to reduce their treasury holdings and buy stocks. And if they don't like what they see in the stock market, they'll start selling. and often sell into a rally. And that maybe, maybe what happened today, or maybe it's just an oversold bounce. We'll see. But I wanted to point that out. If we continue to rally, build on the reversal into next week, then that is it could be a little warning sign for the market. The market's certainly getting stretched, overbought, as I showed you earlier today on the daily time frame. And then the other thing is, so you had Treasuries hit support and bounce today, and the other thing I've been watching lately too is the other risk-off asset, and that's gold. Nope, that's not gold. Wrong contract there. Let's see. Here it is, GC. So this is what I've noticed into the close today. Both Treasuries and gold bounced. As I said earlier today, this is a 60-minute chart of GC gold futures. We have this bullish divergence, PPO starting to turn up. So if we get any more upside in gold next week, that's going to put in a divergent low, and that's what I like to look for here. We've been in a multi-month trading range, so there really wasn't much to do, other than maybe bounce, trade off the range, or use these short-term patterns. But these divergences could very well play out and cause a false breakdown or bear trap in gold. In other words, when you break a well-watched support level, you get a lot of shorts to pile in, weak-handed longs sell out, and if you get a rally in gold, it's not to say that the stock market can't rally as well, but if you're seeing Treasury bonds and gold rally early next week, again, that may be a tell that investors, especially institutions, are selling. Even if the market's up again, maybe they would be selling into strength and moving into treasuries and gold. Otherwise, both of them broken down, so it may be nothing more than just a brief blip. The other one I'm watching too, of course, is silver, and silver just reversed just a hair above that next target there at 17,258. And you can see, ZSL, that's one of the short ETFs for silver that I shared. And I labeled some targets here because I was considering, and still am, adding that as an official trade. But we're going to watch this in the next week. So as of now, did this meet the measured target for that wedge? What you do is you take the widest part of a wedge like this, and which would be right about there, and you add that to where the pattern broke out, and that gives you a measured target. So no, we didn't hit the measured target, and I think a lot will have to do, as I've been talking about, with what the dollar does. We're going to watch this over the weekend as well. US dollar remains in a downtrend, still below the primary downtrend line, so no buy signal there yet. And if you get it, then I believe that will put additional pressure on silver, downward pressure. Now, and if the dollar continues lower, that may help get a bounce in silver and gold. We'll see. You can probably sense a little hesitation in my voice. Gonna, go home light over the weekend, see what happens, see if we get these breakouts, see what the dollar's doing. I'm actually very eager to see how trading picks up, how we follow through to today's moves next week. Okay, and here's what I wanted to show you. I've been looking at this actually for weeks now, but I don't think I brought this up on some of the market-leading FAANG stocks. I've been covering them on the 60-minute time frame. But, I often talk about how QQQ is not representative of the U.S. economy, or the, and as such, the U.S. stock market. SPY, or even the 30 stocks in the Dow, is much more representative because they're more diversified. This is very tech heavy. However, with that being said, technology companies are, even in the S&P 500, although they're not 50% weighting like in the Nasdaq 100 here, they are, it's about a 25% weighting, still big sector. And these are the companies that are driving the stock market. These are the only trillion-dollar companies that we have: Apple, Microsoft, Amazon, and so we'll watch those. So what I noticed is, although we had on SPY back before the top, we did have negative divergence, as I talked about on the weekly chart. Let me turn these lines back on here, or I'll turn that off and draw them out so you can see. So on the S&P 500 and most other indexes, we did have negative divergence leading into the highs in March right there. If I can get the line tool, and that's the divergence right there from there to there. And again, it played out. We talked about we had divergence for a while. We had it here. Yeah, right about there. If we made a new high, yep, we did. And we kept pushing up. And finally, the bigger the divergences they got, the bigger the drop. It finally played out for a big drop there. Now, however, we did not have it on QQQ. And that's one thing that always divergences are not absolutely necessary for a major top or a turn, but they certainly help. We had big divergences leading up to the big drop in 2015. Here's QQQ fell over 20%. We had a little mini crash in a lot of the stocks. That's why it fell so much more than the S&P 500. And even the NDX itself, it dropped 26% from low to high following the divergences that you can see were in place back there. So here's where I'm going with this. We don't have the divergences, or we didn't have them at the previous high, but we will, guaranteed, if the market continues up over the next few weeks. I mean, could pull back a little bit here, but if we push up and oh, you know what? Let me take that back. We already have it on QQQ. We don't have it on all the market-leading stocks, but as of today, we just made a new high, closed at a new all-time high on QQQ, and that gives us negative divergence. It's not confirmed divergence. I always say I like to see the PPO turn back down. Once it turns down, you effectively have a lower peak. Right now, we don't have a peak. The indicators are certainly lower, but they're momentum indicators and they're pointing higher. So if they keep going higher and higher and higher, they take out and they burn through the divergence. So I do want to say that for the first time in a long time, actually since the drop here in 2018, we have negative divergence right there on QQQ. And I'm going to go through the market leading FAANG stocks real quick and try to gauge, see how much more upside we might get in the market. So Apple has also put in negative divergence today. Looks like it took out the previous high just by a little bit. And again, these lines can keep moving, and eventually they may be burned through. But as of now, as of today, and anytime soon, should this rally be built upon, we'll have divergence for the first time in a long time in Apple as well. That was something, again, that was lacking that I saw at the previous high. The market leading stocks never had the divergence. And believe me, I didn't think they were going to get back to new highs after the drop before. But like I said, if I didn't point this out, I'd be remiss. And that's led to the big drops in the past. 39% drop after this divergent high in Apple. 32% followed by, ultimately before all is said and done, 34% drop following this divergent high. This divergent high, 45%. Little divergence here. You can see the drops there. So. And as far as timing goes, well, the divergences are now in place on Apple, so it could reverse any day now. We'd still want to see the PPO roll over, and I'd like to see that lower peak put in, whether it happens next week, 3 weeks from now, or 3 months from now. And it could certainly go that much longer. So again, just like overbought is not a sell signal, neither is divergence. You need to see some type of sell signal, and on that we've zeroed down to the 60-minute charts. Look at things like that. I don't have a clear trend line on Apple. We could probably do something there, but we'd have to look for either some type of candlestick reversal pattern, anything else. But there's your high, and here it is on the daily chart too. You can see the divergent high right there. At this point in time, our divergence continues to build, so that was worth noting. Microsoft, let me go back out to the weekly chart. Microsoft, close but no cigar yet. There's our previous high, so I have a horizontal line here, and you can see the indicators are lagging behind. Microsoft did not have the divergence at the previous high, and will if it makes an equal or higher high anytime soon, because if it does it anytime soon, these indicators will not be above the previous peaks. If it happens 6 months down the road, it is possible the divergences are burned out, but right now they're there. So time frame wise and percentage wise, let's just draw it out like this. Let's just say, and again, this just kind of goes from experience looking at the charts, what it might look like. I would say, let me turn off the drawing tools. A move up here, that could be, what is that, about 2 weeks from now, 13 days. Somewhere in there, we'll call it about 2 weeks, and about 5% higher, 4.5% higher. And again, that's not that there's no resistance there, so it's hard for me to give a price target. At least my trading style, you can try using Fibonacci projections. Some people do, and other things like that. But when a security is at an all-time high, there's no resistance overhead, and a big part of my trading is support and resistance. So again, right now the only resistance level on Microsoft is previous high, and from my experience, when a stock or an index gets there, it usually at the very least pops it. Sometimes you have a reversal right there. Sometimes you even fall shy as well, and that's something else to watch out for. But as of now, almost divergence on Microsoft. Here's Amazon weekly chart. This one we have a big divergent high right now on the weekly chart. You can see there's your divergence line. There's a trend line that I'm watching, one of several. That's probably the most important one. And we kind of have this boxed in trading range here. Amazon, when you look at the weekly chart, it's kind of moving on that level. It's certainly above that right now. But again, big divergence building, but it's potential divergence. PPO is starting to turn down. That's something to note too. You can see the slope of the PPO starting to roll over. So any downside in the next few weeks should give us, depending on how much downside we get, should give us a confirmed divergence. I don't know why sometimes these lines tend to vanish, but see right here we had negative divergence from this point to this point, and that was a 36% drop. It was telegraphed in advance, and we got here, indicated more to come most likely. Yep, 36% drop overall, 32% drop after that divergent high. And again, these divergences dwarf those previous divergences that led to these 32, 14, and 36% drops. Next one up, we won't go through them all, just that Alphabet Class A. Let's turn off all those tools and just all the drawings and say right here, here's our divergence. Again, these indicators are lagging severely. Despite the intensity of the rally, these momentum indicators are lagging. So we are all but guaranteed to have some pretty powerful negative divergences for the first time in a while on Alphabet if and when we get above the previous highs there. So measure it out, try to guesstimate it. Well, just to get up there, and again, I could go straight up, but we're not going to go up in 1 week. It's possible. That would be about a 7% rally. So that would be the quickest, or 6.5%. But let's just say we did it in about 2 weeks, maybe a month. That would be a month out, and that would be about saying 7.68%, where I'm holding it right there. So we'll say maybe 7 to 10%. Again, these are guesstimations. They are not hard targets or anything like that. More importantly, again, you watch the trend. Well, I already had it there. My trend lines came back on. Watch these uptrend lines. Watch the candlesticks. But as of now, like I said, pretty bullish price action this week, and there's certainly a lot of upside momentum right now. But that can change on a dime, and that's why I do these videos. I like to point out things to look out for in advance potential developments. Sometimes they happen, sometimes they don't. But what we have in common, a lot of these stocks are walking up pretty darn steep trend lines, again with negative divergences building, and we'll look out for any type of sell signals. This is Facebook, of course. And until then, I'll continue to look at individual stocks with the most bullish or bearish chart patterns. That's where the opportunities are. Individual commodities, precious metals, and other things, both long and short. The stock market is only one of many trading vehicles out there, and but it's worth doing this analysis because you want to try to align. Once you get in correction mode and these sharp meltdowns, that's when almost everything falls, and it makes shorting a whole lot easier. But again, there are some opportunities right now, mostly on the precious metals as far as shorting opportunities go. And then we're going to wrap it up there because gold, remember the bigger picture on gold is a large negative divergence. This is what it looks like on the weekly chart. We've had 3 weeks of selling, so pretty decent selling pressure on gold. And again, these divergences, you have the PPO crossing down. That's not a good bearish technical posture. Gold is in a bull market, so it could shrug those off. But that's what happened today. I think I already went over that with gold. We hit this support level 158. So GLD on the daily chart has fallen to support. and it is in a precarious technical posture. But as I like to say, and I say this all the time, support is support until unless broken. So these are the things I'm watching for next week. With gold and treasuries both falling to support today, even if they're going to go on to break that, they could very well bounce next week. And if they bounce, that could align with a pullback in the stock market. Like I said, lots of gaps to fill, starting with today's gaps. So kind of pick it up next week, see where we start out, and then go from there. This has been Randy Finney with Right Side of the Chart. Have a great weekend.